Thanks for joining me, Chance. So first off, what's the takeaway for the minutes? Your first reactions?
You know, it's not too surprising to us. It's been a similar story from the Fed for months now, where they're going to keep rates higher for longer. You can see that they're actually guiding to above a 5% rate through the end of 2023, which is not what investors want to hear. The other thing in those data points that they mentioned that surprises us is they're talking about being able to hopefully still have a soft landing and avoid a recession. And yet the unemployment rate that they are projecting for the end of this year is 4.6%, which is about 1% above where we are now. And if you look back historically, whenever the unemployment rate has increased by 1%, you were usually about 6 months already into a recession. So there's a bit of a disconnect there with what they're trying to predict, but we would say that that lines up for our belief that we'll be in a recession at some point this year.
Right. They did say, though, that a recession is plausible in the minutes. So I'm curious, what are the chances, do you think?
We would say it's pretty high at this point. We track numerous different leading indicators, but just to use the leading indicators index that Conference Board uses, that's got a long history. And those leading indicators, things like new orders from manufacturers or building permits that are tracked on a monthly basis, those have been trending down and have been negative for the last 9 straight months. And there isn't a period going back decades where you had 9 straight months of negative growth in the leading indicators and not ended up in a recession. So we would say it's pretty likely.
Now, compared to, we had 2 consecutive quarters of negative GDP in 2022, is it going to be something similar to that?
It could be, although we would imagine it would be deeper than what we saw in the first 2 quarters of 2022. That was more of technical things that kept nominal GDP growth was still high, whereas you had real GDP growth just slightly negative. We think what we're experiencing or going to experience this year is going to be more in line with recessions that the United States has experienced in the past.
So in light of that, at Oxbow Advisors, when do you predict the Fed? What's the timeline of a pivot?
You know, it's tough to say. I think right now they're really trying to hold the line until inflation numbers start coming in significantly lower. But that's going to mean it's going to drag on well into this year, if not into 2024. And really, I think their problem is they need to see 2 inflation numbers. The core PCE inflation, which is a number they explicitly track, that they want to see fall below all of the different treasury yields from the 3-month treasury to the 30-year treasury. They need to see it get below that number, and right now it's not there. And then the other one, I think just optically for U.S. citizens, is you can't say that, okay, we're going to start cutting rates when inflation is still printing at 7% year over year. You need to get that down to a significantly lower number before you could say that you achieved your mission in trying to bring down inflation. So if they're going to keep rates higher for longer, that's going to create a problem for companies, and we think that's going to lead to a decline in profits reported this year compared to 2022.
So do you think there's going to be a pivot possibly next year or 2025?
Yeah, there will be a pivot eventually. If you want to think of it this way, there's an inversion in the yield curve right now where the short-term treasury yields are above the 10-year treasury yield, and that's usually a sign of the Federal Reserve being too tight and we're going to be going into a recession. But whenever there's been an inversion in the yield curve, it always will uninvert. It's just a matter of time, and it's going to come down to the Fed deciding that there's too much pain in the economy or in the credit markets, or things are breaking down or breaking apart, and that will lead to them cutting rates significantly to try and stem the losses.
So we're seeing possibly another 75 basis point hike for 2023. How do you think the S&P 500 is going to perform this year, 2023, compared to last year?
We think it's going to be a difficult start for the S&P 500. We actually remain still very defensively positioned. We have a lot sitting in short-term treasuries, just generating that 4% yield. But right now, we think until you see additional estimate revisions where profit estimates by companies need to be brought further down, and investors have to acknowledge that this is going to be a difficult year for profit growth, until you start to see that, we would expect more pain for stock investors. and that the indexes will continue to trend down. And if it fell by about another 20% from here, that would be where we start to think, okay, now we're starting to get some prices that we're more intrigued by. And maybe there's an opportunity, if this all happens quickly, that we're able to invest and you actually get a bit of a return coming in the second half of the year. But it's going to depend on how fast this plays out.
So speaking of investors, in light of the possibility of a high chance of a recession, do you have any tips?
Our advice would be to stay liquid, keep your portfolio flexible, and stay invested, if you're going to stay invested, in high quality assets. Things that have an investment grade rating, very good balance sheets. You don't want to be sitting in anything that's junk rated or a speculative stock that's out there, because we think there's still going to be more pain for those types of assets for as long as this has to take to play out.
And just one last thing quickly, what's your outlook for the tech sector?
Tech sector, I think it's come down a lot. The ones that have very good balance sheets and generate a lot of free cash flow, we think there could be a bit more of a downturn there, but we would start looking eventually in that area for some opportunities. The tech sector names that have zero free cash flow, those are going to be the ones that we think are still going to have some trouble, just because when investors are really starting to worry about the economy and a recession, if you have no cash flow, it becomes difficult to know what to value those businesses on. And those can keep going even lower and lower than they already have.
All right. Thank you very much, Chance Finucane, Oxbow Advisors. Pleasure speaking to you.
Thanks, Don.